I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, thanks for having me. It's great to talk with you.
Brexit, for some people, was a great buying opportunity. Can you maybe explain what happened?
Yeah, it's actually one of the most fascinating things they have ever seen in the financial markets in a lot of ways. But one of the things that happened, of course, is the market fell quite a lot on Friday and Monday the other week following the vote. The S&P 500 went all the way down to 1990. It dropped essentially 100 points. The Dow down 1,000 points within 2 days. You would think that would scare people, but it didn't. Not at all. In fact, I've got a very large email list, and I didn't get an email from one single person worried about that drop. And on TV, there were a lot of people on Friday that were angry about the Brexit vote and making it sound like the market could be in trouble or the economy could be in trouble or this was some giant news event. So there was some scare talk. There's no doubt about it. But people, as far as individual investors go, no worry at all. And the most fascinating thing is that there's a story in the Wall Street Journal that says that on those 2 days there was some of the biggest brokerage activity in the United States by small account holders ever. Fidelity said that they had the third highest day of trading volume. Now, what's interesting though is that almost all the volume was buying. These weren't people in panic selling, but people that saw the drop as a time to buy, go on margin even, buy more. The top stocks bought were, of course, Apple, because it's so popular with people, even though it hasn't really done anything in 2 years. But so the people saw this as a dip, as a buying opportunity, not anything to worry about. That makes me think that people aren't ever going to worry about the market until they lose a lot of money at this point, because there are plenty of reasons not to be excited about the stock market. It hasn't gone anywhere really for a year and a half now. Most people are actually down. They're not making money because the market's down this year. Many stocks are performing very poorly, such as Apple, as I mentioned. It's down almost 10% year to date, but it's just one of many. So people are very complacent. If to flip it around, in October 2014, there was a correction, and I got a lot of emails from people worried then. And if you think back to December 2012, there's all this talk about the budget in the United States and some budget crisis, and they needed to get a deal going in the market. People were very negative in that December. And sentiment surveys show this, that during those drops, people got a little negative in investors' intelligence and so forth. But on this drop, if you look at just the investors' intelligence survey, it had a reading of about 48% of the people being bullish and 23% bearish before the drop took place. And then after the drop, the number of bulls dropped 4%, but the number of bears didn't budge at all, and that's because those people thought this was just a dip or correction. They went into the correction category. So I think that's pretty much the view of most people, that this was just a temporary dip, just a little correction. Now on CNBC, that's basically what they're all saying. I watched a little bit on Friday. Kramer was basically ecstatic, saying everything is fixed, practically, or just saying you just need to buy stocks. So there's total complacency. And one thing interesting, I think I might have mentioned this in the last interview we did, but in the previous month of May, Ameritrade released figures in June that showed that in May they saw the largest increase of bullish sentiment among their account holders, millions of people. They have something they call the Ameritrade Index, which they use to measure how fully invested people are. They take greater risks by going on margin or buying riskier, more volatile stocks, or they decreasing their risks. Well, in May, that indicator had the biggest jump ever. So the way I think of this is that was a sign of increase in bullish sentiment, and then at the end of last month, we had that 2-day drop in the market, and people just bought more if they could, with no worry at all. I think that's a bad sign of complacency. It makes me think that normally in a bull market, you have corrections, people get scared, and the opposite happened, and that's really not bullish for the stock market. I think we're probably going to see the S&P 500 go back down to that 1990 level this month, maybe bounce off of it again, but I think at some point we'll break it, and it's just going to go back down to lows and be a real mess, because no one's going to get out ahead of time if all that plays out. And the earnings are going to come out in about 2 weeks in the United States or start, and they're expected to shrink by about 5% from a year ago. So there's no economic growth. It's really just the conviction that people have that the Fed won't ever make the stock market drop. They'll do something, and so forth. And that's, they believe that's been the case and will always be the case, but I don't think that's true at all, and it certainly won't abolish even a correction in the market from occurring. We saw one in January. We saw one in August. I think we're going to see at least another correction, and it could lead to a real bear market. And also, something really important to point out, which is more important than the action in the stock market, frankly, is what's going on in gold, what's going on with bonds, because there you saw them go up during those 2 days of the Brexit drop, go up substantially. Gold cleared the $1,300 an ounce level, smashed through it when so many gold bears were saying that wouldn't happen. It did happen. And now that 1,300 level is powerful support, and gold stocks are just accelerating higher and higher. I mean, they're up today. The GDX is up over 1% today. Gold stocks are taking everyone by surprise. One reason that happens with gold stocks is because when the price of gold goes up, their profit margins go up exponentially. That's why they go up faster than the price of gold. It's also why they fall so bad during the bear market, but we're in a bull market in that case. But the bond market is real interesting, because it went up in the 2 days during that Brexit drop, and it's still going up. And gold is still going up. So those two markets reacted and have not stopped reacting, even though the stock market rebounded. So I think people buying bonds are doing so worried about the economy, worried about more financial problems or bad news or whatever the case, and they're not done worrying about it. And some people are going into gold to get out of currencies, to get out of dangerous, shaky stock markets. And the thing is, if you look outside the United States, many of these markets in Europe, in China, in Asia, all over the world, for the most part, had barely budged off of the low following the Brexit thing. So people are really staring at the S&P 500 in the United States and, trying to buy their favorite fat stocks, ignoring what else is going on in the rest of the world and what's going on in the bond market. But more importantly, they're ignoring the gains that they could be making in gold, because gold's in a real bull market. The gold stocks are the best sector this year. They're just going up, up, and up. Newmont Mining is up like 200% from where it was on December the 31st, and so is Barrick Gold, and the small juniors are up, many of them up even more than that. So it's tremendous money that's being made by people in the gold market, that it's not so much people need to, at this point, sell their apple to escape the potential drop, but to sell it so they can buy gold stocks. And if they want to make money, that's where they want to do it. The thing is, if you think about the stock market and the financial media, if you can go back to 2013, 2014, 2012, when the market was going up almost every single month to a new high, you could turn on your CNBC set and watch that Fast Money show, watch Kramer, and you could get right down to stock picks that they give. And if you were buying those picks, you would find that these are stocks that usually made a new 52-week high. You'd buy it, then they'd pull back a couple days, maybe a week or two, but then they'd eventually make a new high. So you can make money doing that. And they're picking out stocks that were basically making new highs all the time. Now, if you turn on those shows now and watch, what you're going to see are them guessing bottoms. They'll say, well, this Chipotle, Kramer 2 or 3 weeks ago said Chipotle's a buy. It's fallen like from 600 to 400 or something crazy. Fitbit, you said, was a buy. What they're trying to do is pick bottoms instead of buy stocks making new highs, because that's what's really going on with the stocks inside the stock market. And that's not a bullish market environment. It also makes it very difficult to make money buying stocks, even if that's what everyone was doing in these brokerage accounts the other week. The way to make money in stocks is to buy where the money's going, and that's mining stocks, because mining stocks are doing what those stocks, Kramer and the Fast Money people, were picking out in 2013, 2014 were doing. So the mining stocks, they make a new high, and then you think, well, it's got to pull back. It's got to pull back. It's up so much. And sometimes they do pull back, but they pull back for a week or 2 weeks at the most, and then they end up making a new high. So the way to make money is invest in things that make new highs month after month, and that's what the mining stocks are doing. That's what gold's doing. I think it's going to continue for the rest of this year. Yeah, at some point there will be a 10 or 20% correction. I have no way to predict, talking to you, when that's going to happen. I just know they're starting a new bull market this year. They're going to go for 3 to 5 years. That's on average how long those bull markets last. So that's fun, I like to buy into something like Barrick or Newmont. I don't own them too. I own other ones, but I'm just using them as examples. I mostly own smaller ones. But the point is that, it's money being made there.
We'll have more with Mike Swanson right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Mike Swanson. Mike, is one of the reasons why you're high on gold and others are too, is that They say even if all the gold producers out there, mine as furiously as they can, they will not be able to meet the physical demand this year.
Oh, yeah. Well, that's what happened because of the result of the bear market of 2011 to really last year. That bear market was brutal. The lower gold prices caused many mines to simply cease operating and shut down because the cost to mine it was higher than the cost of gold, and so forth. Lots of junior miners and exploration stocks have had to vanish. They couldn't raise money anymore. They disappeared. So the industry really hit dire straits, and that's what bear market bottoms are made of. Because when production gets taken off the market, eventually prices will stabilize, and slowly money is starting to flow back into investing in the mining stocks and helping finance the smaller ones. But it's starting to happen. But it's a process that takes years for a company to, let's say, buy a mining property and open the mine up. It typically can take 1, 2, 3 years even. And that's not even factoring in the length of time it takes to explore and discover a deposit. So we basically had a 3-year black hole where nothing's going on, and now activity is starting to happen. But it's going to take years for the production to really increase enough to match the demand, which is increasing, because of the turmoil going on in the world economy. Demand is way outpacing production. The other thing, though, that makes the mining world a fascinating place to invest is in the grand scheme of the financial markets, it's only a small amount of money that's in there now. So, for example, if you look at the ETF GDX, which I do own, it's ETF that owns, it's the most widely traded gold stock ETF. It's got a market cap of $7.16 billion. That's how much money has been invested in it by people such as me. I don't have that kind of money, but my small little drop in the bucket, helps a little bit, I suppose. Well, that's 17 billion, okay? Now, if you look at Apple's got a $520 billion market cap just by itself. Well, Apple is such a big company. Let's think about Netflix. Netflix has a $41 billion market cap, and the funny thing about Netflix is that it doesn't actually make much money to justify that. It's got a gross profit of $2 billion, a net income of only $126 million. So it's a company that makes $126 million and has a $41 billion market cap. The point is Netflix is one stock in the entire stock market that is popular, people love to trade. It's got a $41 billion market cap. GDX, the most popular ETF for gold stocks, has only a $7 billion market cap. So that's just to say that there's very little money actually invested in the entire mining space. Now, if you add up Newmont and Barrick together, you're going to get about 50, but they're the biggest ones. So it just takes a little bit of money flowing into the sector to make it go up like it's done. And you add onto the fact that this is the hottest sector of the year in the entire stock market, that just makes it more likely that more and more money is going to flow into it because hedge funds, technical traders, they want to buy ETFs, they want to buy stocks that are beating the rest of the stock market. And if the stock market continues to go sideways, if the market falls, the situation will be even more pronounced. But the longer and longer the outperformance in the mining stocks relative to the S&P 500 continues, the more money is going to flow in there. And that situation can last for a long time. So I think we're just starting something that's, going to benefit anyone who can buy right now, even if the stuff were to pull back for a couple of days or a week, I don't think it really even matters at this point.
Getting back to Brexit, the panic in London has seen 3 British real estate trusts ban the investors from taking any money out. Is that going to have shockwaves?
I didn't know that. That's pretty scary. Well, we live in a strange world because you don't know. Something like that could happen. That sort of thing happened to the people of Cyprus. I was about to say Greece, but it was Cyprus, where they forced people to take something like a 10% haircut on all their deposits and gave the money straight to the banks. Just gave it to them so they could recapitalize themselves. Imagine having a bank account and having your money stolen like that and given to the bank executives.
Well, now
that's what happened there.
I was going to say, well, what's the talk now is the same thing can happen in Italy. They're in that kind of trouble.
Yeah. Well, even if something like that doesn't happen, you're still in a very bizarre situation because we have this negative interest rates in parts of Europe, in Germany, and I think in Switzerland today reached negative interest rates. At some point, that might affect people's bank deposits. Imagine having a deposit at the bank and you're being taxed for depositing money at the bank. It's very strange. And of course, the logical conclusion out of all this is there's 2 things you really need to do. That's have physical cash and have gold, have metals, have gold and silver of ownership. So I'm not scared, thinking that it's going to happen tomorrow like that in the United States, but there's nothing wrong with not simply preparing for any potentialities, but look, these things are going up and making money anyway. They're growing in wealth, so why not invest in something that protects you from a potentially bad scenario that's going to make you money anyway.
Mike, thank you so much for chatting with us.
Thank you. It's great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.